Welcome to Business Edge. I'm Esther Awuni. Glad you could join us today. Now, it's been 6 months since Nigeria's monetary policy authorities met to review the state of the domestic economy and decide on interest rate. Now, that's about to change with the release of the new calendar for 2024 beginning in February. Now, there appears to be a general consensus that the MPC will maintain a hawkish stance this year as it focuses on fighting inflation and boosting monetary transmission. Now, on the show today, we'll take a deep dive into the strategy for the MPC this year and how it will impact the economy. Also on the show, we'll review a number of top business headlines from the continued weakness of the Naira at both the official and parallel markets to the Electricity Act of 2023 and much more. In the meantime, we'll bring you the top business headlines after this break. To join us again. Welcome back. Nigerian banks could soon see their capital requirements soar, potentially exceeding 900 billion naira for international banks. That's according to a report by CardinalStone Securities. This move, hinted at by the central bank governor, aims to fuel the government's 1 trillion naira GDP target within 7 years. The report predicts varying capital increases based on bank type, with regional banks needing at least 181.85 billion naira and international players potentially reaching 909.27 billion naira. Now, this hinges on the possibility of the central bank revisiting its 2005 capital to GDP ratio benchmark, which ranged from 0.04% to 0.22%. However, the report warns that a 1 trillion naira goal might necessitate even stricter requirements. Notably, analysts highlight a concerning decline in real capital to GDP ratio since 2005 from 0.04% to 0.02% to 0.00% to 0.01%. Now, this potential capital hike could significantly reshape Nigeria's banking landscape, but whether it materializes as predicted and how banks navigate it remains to be seen. Well, elsewhere, Nigeria's electricity sector is gearing up for a significant shift as the Nigerian Electricity Regulatory Commission, the NERC, sets the stage for implementing the Electricity Act of 2023. This landmark legislation grants states the power to generate and regulate electricity within their regions, marking a major deviation from the previous centralized system. To ensure a smooth transition, the NERC chairman, Sanusi Garba, recently inaugurated 3 working groups at a stakeholder meeting in Abuja. Now, these groups specialize in legal and regulatory, engineering and technical and commercial transaction matters will provide expert guidance in navigating the complexities of the new act. The NERC, however, recognizes the need for collaboration and will actively support states as they build their regulatory capabilities. Now, this collaborative approach aims to ensure a seamless transition and optimize power generation and distribution across the country. Meanwhile, PwC's 2024 economic outlook predicts persistent trouble with South African freight, rail, and ports, leading to ongoing supply chain headaches. This comes as the top of international conflicts disrupting global shipping and material flows. Transnet, the state-owned operator, bears the brunt of the blame. Management turmoil, derailment, and equipment shortages plague the entire system. Additionally, PwC calls for reducing reliance on conflict-impacted supply chains and prioritizing domestic sourcing and production. However, challenges don't end there. Erratic energy supply, struggling public institutions, unemployment, and crime paint a picture of broader economic hurdles. A public services PwC reports saw a substantial decline in usage between 2019 and 2023, highlighting the strain on state infrastructure. South African businesses must adapt to navigate this turbulent landscape. Diversifying supply chains, embracing domestic solutions, and staying resilient will be crucial for weathering the storm in 2024 and beyond. Those are our top headlines. We'll take a quick break. I'll be right back to take you through the market from yesterday. Do join us again. welcome back. Let's just quickly take you through trading at the Nigerian exchange yesterday, where we saw the momentum gathering more steam as the all-share index rose further, this time by over 1%. We saw market heavyweights like Dangote Cement, Boa Sugar, and a number of other blue chips also contributing to the rally yesterday. And the market also hit another milestone at over 95,000 points. Let's just take you through the numbers now to see, get a better picture of how the markets closed on closed in the previous session. So you're looking at the all-share index, that's up 95,000 at 95,768.12 points. That's up 1.30% yesterday. Let's take a look at the market capitalization. Well, that also went up yesterday, 1.30%. So in the last 6 days, that means that the market has gained over 15% in the last six trading sessions. That's from last week, Monday, up until Monday yesterday. So that's over 15% gains for the market. Let's go over to the top gainers for yesterday's session. Well, there you have it. We have a mixed bag here of top gainers from yesterday's session, but also featuring prominently again is Dangote Cement, one of the top market leaders, and a big factor for this rally that we're seeing so far. It was up just under 10% yesterday. Excuse me, we have Eterna from the oil and gas sector, up 9.8%, Qtix up 8.89%, and Triple G also coming in the third position yesterday, closing at $2.35 per share. If we could just quickly move to the top losers now from yesterday's session. Also a mixed bag. We have Cadbury there, down 10%. Sovereign Insurance from the insurance sector losing 10%, closing at 54 per share. Flour Mill from the consumer sector down 10% also. So but we're mostly seeing the heavyweights, the market heavyweights, particularly from the banking and the industrials particularly leading this rally. Let's take a look at the sectoral performance, give you a broader picture of how the entire market performed. And that's for the sectoral indicators that we track here on the show. Banking index, well, that was up yesterday 0.90%. So you can see that market breadth was a bit weak, but regardless of that, because some of the big names like Dangote Cement were in positive territory yesterday, that was able to still lift the market, even though we saw the sectoral performance in the red. Insurance, oil and gas in the red. Well, that's it for the market today. Of course, we are still tracking the numbers. Market continues to trade for the rest of the day up until 2:30 p.m. today. Let's just take a break, and we'll be right back with the rest of our conversation. Well, we're looking, our first conversation, we're looking at monetary policy strategy for 2024. The Central Bank of Nigeria recently released a calendar for MPC this year, starting in February. So we're going to be talking about the strategy for this year. But in the meantime, we did ask some analysts what they expect in terms of the MPC's decision this year and what the strategy will be. Let's listen to them before we go over to our guests.
Policy Committee, created by the CBN Act in 2007, supports the economic policy of the federal government and assists the central bank in attaining price stability. It advises the central bank, government and financial industry, setting interest rates, reviewing policies and ensuring clear communication. However, for 6 months, the committee did not meet, creating what some analysts described as uncertainty and anxiety in the system.
Changing the narrative, especially in the monetary policy side. It has not been good for Nigeria if you've not had your MPC meeting for a very long time. Unfortunately, I don't have so much high expectation, maybe based on their utterances by the CBN governor. I think it will be same of same.
So I feel that while we were having MPC meeting, the CBN governor has been using other monetary policy to actually control the economy.
The CBN has announced its first policy meeting under the current governor, Olayemi Cardoso. The meeting is scheduled to be held between February 26 and 27. The MPC raised the benchmark interest rate at its 292nd meeting in July by 25 basis points to 18.75% from 18.5%. Analysts have expressed differing thoughts on what their expectations are for the February meeting.
I expect the CBN to come up with a clear-cut formula on going forward and how to address the FX issues. I think for me, that's the news that every economics analyst or every businessman wants to hear.
The only change that you will likely want to see on CRR is the fact that to ensure that the debit from banks are uniform. But for NPR, I think that we will likely see rate hike. I won't be surprised for 100 basis points. And my view is based on the fact that last year, inflation actually increased by about 625 basis points thereabout, and we only hiked rates by 225 basis points.
With the MPC's first meeting under Governor Cardoso set for February 26 to 27, the pent-up anticipation is palpable. Will the MPC raise the benchmark interest rate again? By how much? And what will the ramifications be for inflation, growth, and market performance? Businesses are holding their breath. Investors are poised to react, and the entire economic landscape awaits the committee's pronouncement. In Lagos, for News Central, I am Perpetua Fasomipita.
Well, joining me now for more insight on this conversation is Kyari Booker, the CEO of Inlax. Kyari, thank you for joining us today. As you know, this MPC or the CBN has released the MPC calendar for this year, starting in February. Now, we have heard the central bank governor speak at a number of events where he's sort of giving clues as to what direction the MPC could potentially take this year. If there's one thing he said, is that there will be more focus on in fighting inflation, ensuring price stability, and also he has also mentioned or hinted, if you were, that there will be less deficit financing for the fiscal authorities this year. But the opinions are mixed in terms of what direction the MPC could take also. But I'd like to hear your opinion, just hearing that the calendar is out, the first time in 6 months, and how the MPC would proceed from here.
Thank you, Esther. The fundamental thing about Yemi Cardoso's pronouncements since he came into the governorship of the central bank is that the central bank would now go back to the orthodox, rational principles of what the central bank ought to be doing, which is basically what you've listed there: prioritize inflation, fighting of inflation, price stability, and by so doing, whatever actions the MPC meeting does would then channel into the economy. And I think that is a breath of fresh air. The other thing that had happened in the previous administration of the central bank is the unorthodox nature. Even the bankers sometimes do not know how their CRR are determined. In fact, there was the introduction of discretionary CRR, which basically means that when they see a large amount of money coming into a bank, the central bank mops it up. So even though technically it is 32.5%, the central bank in the previous administration or the previous central bank administration had been, for banks, it is far higher than the 32.5 that had been announced. I think what we're going to see is most definitely for the remainder of the year, a more orthodox policy and an anticipated rational reaction to market forces. In fact, I have seen some analysts, including both domestic and international, anticipating a slight increase in the first meeting, which is to say that anywhere from 200 to 500 basis points increase in the MPR may actually happen. And that's in anticipation of the fact that in the last 6 months, inflation had been ratcheting up, whereas there hasn't been much in terms of monetary policy in other than the mopping up and other than the OMO windows in terms of those dynamics in trying to reduce the risks of inflation. But with the MPC meeting scheduled for a month from now, what we anticipate is that the central bank will do its best in what is expected of the central bank, which is to begin to handle or tackle the issue of inflation and, of course, maintain price stability.
Well, you're absolutely right. And one of the major issues or problems or challenge, if you were, that the CBN has been effective monetary transmission. Not just the CBN here in Nigeria. We've seen that happen across sub-Saharan Africa. And if we take inflation, which many believe will be right at the center of the CBN's policy or focus this year, inflation. But what we're seeing and what we've seen in the last couple of months and even up to over 2 years has been the supply side pressure, the food inflation, which continues to stoke overall headline inflation. We know that many of it, the challenges are structural, transportation costs, storage, etc. Forces that the monetary authorities do not have any control over. It's the fiscal authorities who should address insecurity in the food belt, ensure that farmers are able to go to the farms, ensure that the produce are able to come from whatever region they're coming from, across the country, etc. That could maybe to some extent potentially limit the CBN's the tool to fight inflation. But nevertheless, we know the CBN will continue to hike. But I'd like you to speak to that point, the point of inflation and achieving monetary transmission in the process. What do you foresee? Will inflation come down if they, for instance, hike by 100, 200 basis points? We're currently at 18.7. Do we have to go up to 20% in MPR before we can begin to see that pullback in inflation?
But by increasing the MPR rate, there may be some effect. But fundamentally, it is actually what you have said, which is that our economy, the supply side is the most important dynamic in inflation, particularly if you look at food inflation, where we have a large tract of arable land, but people, the farmers, have difficulties in accessing their farms, and therefore there may not necessarily be growth in output of agricultural or food, agricultural commodities. Then we have a fundamental structural issue that need to be tackled. And fundamentally, that basically comes down to the fiscal authorities and also the presidency, in the sense that the security issues are not the here and now. We don't have to wait until Abuja is attacked before we make any moves. What we need as a country now is to have a situation where the security issues are tackled head on. And if that is done and farmers can have access to farms, then we may begin to see a relief on the food inflation aspects. Of course, with the monetary policy, rate being increased, it will have an impact as that will also assist in reducing it. But for somebody to actually tell me that that is the most important tool we have left for us means that it's the only item that we can actually, the central bank can do something about. However, on the fiscal and also at the presidency level, there are some more far-reaching forces or tools that must be urgently used to address the issue of food inflation.
Could you give us an example? Could you give us an example? We know that the CBN also uses the OMO bills to mop up excess liquidity in the system in addition to raising the MPR. What other tools are at the disposal of the monetary authorities?
With the central bank, it is mainly basically the OMO tools and the interest rate, which is the MPR rate. In the unorthodox days, the central bank was also mopping large deposits from the banks, and by squeezing or raising the CRR. CRR today is 32.5%. It may probably be the highest in the world, if not close to being the highest, because ordinarily banks are supposed to use the funds that the funds that are deposited to actually on land. So if you take 32.5 naira out of every 100 naira deposited, you are left with very little to lend, even though the central bank also insists on a loan to deposit ratio of 65. Therefore, 65 of those remaining naira need to be lent out. And with the macro situation in the country, it becomes extremely difficult to, have a decent lending, opportunity for the banks.
Right.
So I think the tools that the central bank has, the real hammer is the MPR rate, and of course the OMO, which basically means going in and mopping up some of the primary and secondary papers. And at the same time, with the CRR issue, either they might tweak the CRR, which I don't expect, because 32.5% is high enough, and therefore those are the two tools that the central bank has. But the fiscal side need to be there, right. And unfortunately, it's not an immediate transmission force, because right. It takes time for the fiscal moves to result in an outcome.
Right. Something else that the markets, investors will be watching out for is how the CBN addresses the issue of naira scarcity, boosting the naira. We know the reserves are somewhere at around $33 billion. I mean, receipts from crude sales are not, coming in as much as the CBN, indeed, the government would love to, but, that is something that the CBN has to tackle. That's protecting the naira or strengthening the naira as much as it can. But what is your take on how the CBN could potentially go about that this year?
I think what we have seen is that the forward sales of the crude is still probably, that lingering effect is probably still there. And otherwise, there has been an increase in oil volume, meaning the production rates. Prices of crude oil has remained high, or marginally decreased since its peak in the last few weeks. Therefore, what one would say is that where is money going? And my guess is that we may not have cleared some of our swaps or the swap arrangement. If that's the case, then we may not see much other than to borrow, which is what had happened with the Afro-Exim loan. And I have seen something in the papers these days that another $1.4 billion would also be borrowed. Now, those are probably stopgap. If in the next month or two, the forwards the swaps and all the payments would have been dealt with, then we may begin to see FX inflow into the country. But the fundamental thing about FX inflow is actually what the central bank governor had mentioned up initial, which is that the days of unorthodox policies are gone, and that should engender trust with the foreign investors. And with the recent peak in the market, so to speak, right. I would expect some level of FX inflow coming into the country, foreign portfolio investments, which some people would believe is hot money, but it may actually be a panacea for us to say, look, we are going to be trusted. There won't be policies so much solved as far as monetary policy is concerned, and right. That needs to be backed up with fiscal stance. And at the presidency level and at the legislative level, to show and demonstrate to the world that Nigeria is open for business.
Right.
That has not yet been clearly articulated in my views.
If I could just come in here, something else that will be on the radar for everyone, markets, banks, and indeed even foreign investors will be how the central bank handles deficit financing this year. The overdrafts that the government sends to the central bank by the means of the ways and means. We've saw what's happened in the last couple of years, and that revelation of over 20-something trillion in ways and means, and that drama over whether or not to securitize it. Well, part of it has been done, but we have heard unconfirmed reports that this might be happening again. Those overdrafts being sent, but this time, what's different this time that we're hearing and still not able to independently confirm is that the CBN may have refused those overdrafts because obviously what's on the table is still a lot in terms of the ways and means that have yet to be paid. But what are your thoughts in terms of how this new central bank governor with this new mandate would navigate this particular issue? It's quite a sensitive one. We have a government that's cash strapped. We have oil receipts that are falling short of revenue targets, etc. How do you see him handling this sensitive, striking a good balance?
Another thing about the orthodoxy principle that had been expressed by Mr. Yemi Cardoso, the central bank governor, is that there will be ceiling as to how much ways and means that can be exercised. And that ceiling, I believe, if I'm not mistaken, is something in the neighborhood of 5% of the previous year's revenues. Now, if we were to hit that limit, then there won't be additional ways and means exercise. And if that's the case, then on the fiscal side, we have to cut our cord according to our cloth. We have to live within our means, and that would basically means that certain drastic measures need to take place. I think the other element is that rather than ways and means, then the fiscal authorities might end up doing what one would call borrowing if there is a deficit financing necessity. And in which case, then we may have to be very prudent and look for borrowings that would result in returns that are going to be more than the amount being borrowed, meaning that if it is for capital projects, if it is bonds or schools that are involved in roads, bridges, and what have you, that has economic impact, then it might probably augur well for us long term, in the immediate as well as long term. So it's not that we shouldn't borrow per se, but we should do it in a very meaningful and thoughtful manner.
Right, we have just 60 seconds left. I just wanted to hear your thoughts on the upcoming recapitalization exercise for banks and how it could potentially change the industry. Are you expecting to see M&As, mergers and acquisitions? That had always been the outcome in Nigeria when that comes, because it means that the banks that do not have enough capital may have to go to the market to raise capital, or they may be forced to merge. And I think long term it might be good for the economy, because banks would then be able to deal with larger ticket transactions. And I also would like to see something that would enhance the corporate governance of the banks, because chances are that bank failures are not necessarily as a result of not meeting certain requirements or ratios or whatever, but it is fundamentally tied to how well the bank is or had been governed. So I think corporate governance, insistence on good corporate governance is fundamentally important as far as the regulator is concerned. Well, Carrie, I must thank you so much for your time today and all that great insights that you've shared with us today in terms of monetary policy direction for 2024. Of course, we'll keep our fingers crossed and keep our eyes on the NPC. I've been speaking to Carrie Booker as the CEO of INLAX. In the meantime, let's take a short break and we'll be right back with international headlines. You're still watching Business Edge. On to international headlines now. British businesses are warning of a new wave of post-Brexit trade disruptions because EU exporters are not ready for UK customs changes, which starts this month, and Britain's port infrastructure might be unprepared too. Britain left the European Union single market in January 2021, but it has repeatedly delayed imposing checks on EU imports. By contrast, the EU immediately enforced its rules, leading to port delays in 2021 and prompting some British exporters, such as cheesemakers and high-end beef farmers, to give up on selling to the bloc, at least initially. Elsewhere, global stocks hovered near one-month highs on Tuesday after the Bank of Japan left monetary policy unchanged, boosting the yen and Japanese stocks, while Chinese equity investors took a little heart from speculation of a huge government rescue package. The MSCI All World Index was up 0.2% near one-month highs, thanks in part to a 3% rebound in Hong Kong stocks that slumped the previous day when foreign outflows gathered pace and short selling surged. The Chinese stocks staged a more muted recovery, having touched their lowest in 5 years the previous day after the country's cabinet pledged to take more effective measures to stabilize market confidence. One option included mobilizing some 2 trillion yuan, that's $278.53 billion, to support the stock market, according to a Bloomberg News report. Now, the commodities market, oil held against gains after the US and the UK made a fresh round of strikes against Iran-backed Houthi rebels in Yemen, fanning tensions in the Middle East and offsetting concerns global supplies remain ample. Global benchmark Brent was steady above $80 a barrel after rallying almost 2% on Monday, while the West Texas Intermediate crude was below $75 a barrel. US and UK forces launched their latest attacks against 8 Houthi targets in an effort to prevent the group from attacking commercial vessels in the Red Sea. Crude ended higher in the week's opening session after reports of Ukrainian drone attacks against energy facilities on Russia's Baltic coast, opening a new front in the country's conflict almost 2 years after Moscow's invasion. Well, those are the top international headlines we're tracking at this hour. We'll take a quick break and I'll be right back with the rest of the show. Welcome back. We have a guest joining us, Emmanuel Odiaka. He's the CEO of ECOP Capital, to look at some top headlines that we're tracking. But first, let's take our first story. The Nigerian National Petroleum Company Limited plans to prepay future royalties and taxes to the federal government using the $3.3 billion financing from the African Export-Import Bank. Now, to mitigate default risks, the NNPCL set a lower benchmark of $65 a barrel for the crude-for-cash loan, given the current global benchmark of $78 per barrel. While higher oil prices accelerate payback, lower prices may impede progress. Emmanuel, if you can hear me, let's just get right to the story to hear your thoughts on this story. What is significant for you in this story?
Thank you for having me once again, Esther. Well, what's significant there is that presently the Apex Bank is facing a cash crunch in FX liquidity. So the significant thing here is that this will avail the CBN the opportunity to have some liquidity to further offset some forward due effects in the system that they have pre-planned before now to pay back, and possibly create some additional liquidity in funding import obligations. So that's a significant thing there. So aside that, another significant item is to say that, yes, of course, while the deal has been brokered, it's also a mortgage on future earning of FX that should be accruing to the reserves.
Now, when the initial details of the Afrexim deal emerged, there were concerns about the benchmark rate used for crude oil, with the revelation that it is set at around $65 a barrel. Do you think this is good enough, considering that Nigeria will give 90,000 barrels of oil per day for 5 years?
Well, we are left with little choices. Let's not forget that the previous administrator also brokered a similar deal, and it seems as though a lot of our future oil revenue has been mortgaged already. So it was a welcoming situation in as much as it was going to create immediate liquidity impact that the Apex Bank will use to offset its forward obligations. With the benchmark set at $65 per barrel, considering geopolitical issues, talking about Ukraine-Russian conflict and the Hamas-Israeli conflict, it's expected that it's expected that crude oil prices in the global international market will remain elevated beyond $75 per barrel for the foreseeable future.
Let's get to our next story, and that's let's look at the weakness of the Naira that we've been seeing at both the parallel and the official market, at the official NAFEM market, somewhere just over $900 to the Naira, and also looking at the parallel market at around 1,300. We know that the CBN will be focusing on strengthening the Naira this year, but obviously there continues to be that supply issue. There's talk about a possible $1.5 billion loan from the World Bank to help boost the strength of the Naira, at least in the short to perhaps immediate term. What are your thoughts on this?
Well, going forward, the Apex Bank is left with very tight policy tools that they could use to continue to support the currency. It's a good thing that we are going to likely see the Apex Bank move away from non-orthodox monetary policy tools that the previous CBN governor had installed in managing the FX issues into orthodox monetary policy tools in fighting and inflation targeting. Going forward, Esther, we have not still seen any easy way out for the Apex Bank. At the end of the day, it's all about liquidity. There are rumors, strong rumors, in market that we could see further hike in monetary policy rates, which is presently at 18.75%. Let's not forget that inflation has ticked as much as 28% plus. So even monetary policy rate as it is still lagging behind where inflation is. Possibly that's why Governor Cardoso has said it's going to be inflation targeting going forward. But even at that won't solve much, because we should be looking at improving our dollar earnings. And a way to improve our dollar earnings at the immediate would, number one, be to ensure that we meet OPEC's quota, which is $1.8 million per barrel. I think we peaked at $1.4 million per barrel. So we are still lagging $400,000 per barrel. So you can imagine what extra accrual of $400,000 per barrel would do to the reserves. So we need to politic. There has to be some high-level politicking to ensure that the international oil company invests back. Unfortunately, we have seen news around Shell trying to pull out from, of course, well, that's the downstream sector, which doesn't really affect production. But we have to get more people to invest in the oil sector to shore up the reserves and deal with insecurity in that sector also. Yeah. Secondly, there is an avenue for the Apex Bank to explore the foreign portfolio investors' influx into the system. Possibly that is why from the onset this year, we saw an immediate implementation in open market operations, which was issued at 17.75% at the initial. That was a welcoming development, but they have to do more. They have to do more from experience. We have backlog of FPIs that have not been able to pull their funds in the last 5 years. Thankfully, these governors see that as a priority. Now they should move beyond that and create a guarantee for FPIs. It's not something that is usually done, but we need it at this point to shore up investors' confidence to bring back FPIs. These are the only short-term ways to fix the illiquidity we are facing.
Right.
in the
While
country
that
right
is
now.
happening, at the same time, businesses need to plan. It's a new year. We're still in the month of January. Businesses need to plan. So, and if they're planning in terms of, especially those who are exposed to the dollar, what rates are they to plan with? We've heard different suggestions or predictions in terms of what the trading band for the naira can be. Of course, taking a cue from where it continues to trade at the NAFE market between 800 and sometimes $900. But my question is, to what extent is this a difficult one for businesses in terms of how they plan, factoring the exchange rate going into the year?
As difficult as your question may be, Esther, let's not forget that under 8 months of this new administration, the naira has depreciated from 750 to $1 to present 1,370 or 75 to $1. That's alarming. That should be a national disaster to be called on what is going on right now. So talking about planning, it's very difficult to advise anybody at this point on what stance to take concerning the FX situation. When it was close to 950, some of us said, well, 1,000 would be the peak, and we might see this administration intervene at that point. We crossed 1,000, nothing happened. We crossed 1,001, nothing happened. We crossed 1,200, nothing happened. We have also crossed 1,300. The reality, Esther, is that the NAFEX window is not giving the true picture of the situation we are facing. The question is how many importers, how many persons that has to do with FX are assessing FX at 900, Esther? It's not there. It's not available. So the reality is that it's a situation where we have to face that the parallel market is dictating the tone of where the foreign exchange is, and which is today prevailing at 1,380 possibly. So that is alarming enough to see that this administration moves quickly to curtail this. Because no matter what inflation targeting the Apex Bank has in its mind, there's going to be imported inflation because imported goods, unfortunately, because we import basically.
Emmanuel, we're going to have to leave you there, but thank you so much for sharing your thoughts with us and that insight, taking us through some of the top business headlines this morning. Emmanuel Odiaka, CEO, ECOB Capital. That's it on this edition of Business Edge. Many thanks for being a part of it. Remember to follow us on social media. We are at News Central TV. From myself and the team, it's bye for now.